Someone sells a small business a workflow. When a lead fills out a form, an AI model reads it, scores it, writes a personalized reply, books a call, updates the CRM, and pings the sales team. Building it takes a weekend. The client pays $3,000 upfront and $800 a month afterward. Because the thing keeps running whether anyone touches it or not. Do that 10 times and you have $8,000 a month of recurring revenue against a tool. Bill of maybe $200. You might assume that's the whole business: build the asset once, collect indefinitely, scale by repeating. That arithmetic is real. It's also the least important part of the story. Because in this business the thing you build is not the thing you sell. And the moment you understand what a client is actually paying for, the entire economic shape of the company inverts. The interesting question isn't how much an AI automation agency can charge. It's why, when the delivery cost is genuinely near zero, so many of these companies plateau, shrink, or quietly turn into something else within 2 years. Start with the retainer, because that's where the misunderstanding lives. The pitch treats it as a software subscription. The client treats it as insurance. When a business pays $800 a month for an automation that already exists and already works, they are not renting the code. They are buying the guarantee that someone competent is holding the rope if it stops working. Nobody signs that agreement expecting to receive anything new. They sign it expecting to never think about it again. That distinction sounds like semantics until the first Tuesday morning when the client texts at 7 a.m. Because leads stopped arriving. Software revenue is decoupled from labor. Insurance revenue is decoupled from labor right up until the claim. And in automation, claims arrive on a schedule you don't control. So what does that obligation actually cost? Not what most people budget for. Ask a new agency owner about their expenses and you'll hear about tools, the workflow platform, the model API, a scraping service, a database, a scheduler. Those are real, and they're small, for a modest client base. Plausibly a few $100s a month in total. The expensive inputs never appear on that list. The first is sales attention. Small and mid-sized businesses do not have a budget line for autonomous systems. Which means every deal requires educating a skeptical buyer about a category they can't verify. Reported sales cycles in this space run from a single call to several months depending on deal size and how technical the buyer is. And the variance itself is the cost, because you cannot forecast on it. The second expense is context acquisition. Before you automate a process, you have to learn a process, including the undocumented parts, the exceptions. The one employee who does the step manually because the system never handled it right. That discovery work is where most of the real hours go. And it is almost never billed at what it's worth. Which brings us to a piece of accounting that quietly determines whether these businesses work at all. Most automation agencies build on platforms that bill by consumption, Zapier charges by tasks, Make by operations. Model providers by tokens. The agency prices a flat monthly fee. That means the agency has sold a fixed price against a variable cost. And the variable is controlled by the client's own success. A client whose lead volume triples is a client whose automation now costs 3 times as much to run. On a small retainer, a busy month can compress the margin badly. And on a large volume workflow it can invert it. Experienced operators handle this by passing platform costs through directly or by putting usage tiers in the contract. Beginners discover the problem the month a client goes viral. It's the first hint that this business behaves less like software and more like a utility reseller with no hedging. Still, none of that is fatal. Pricing can be fixed. The structural problem is different, and it starts with a strange property of the deliverable: it deflates. Whatever capability you sell today is on a path to becoming a checkbox inside a product your client already pays for. This isn't speculation, it's the observable behavior of the platform layer. Model pricing has fallen sharply and repeatedly since 2023. With each provider generation delivering comparable or better capability at a fraction of the prior cost per token. The workflow platforms themselves have shipped AI assistants and agent features that do, natively, a version of what agencies were charging to assemble. CRMs added AI summarization and drafting. Support tools added AI resolution. Every one of those releases takes something out of the paid service column and drops it into the included features column. The consequence is subtle but brutal. Your best demo is an advertisement for your own obsolescence. You are teaching the client a category. And the category is being absorbed by vendors with distribution you can't match. And there's a deeper version of that exposure. You do not own your product. You rent every component of it. The model belongs to a lab that can deprecate a version, change a safety policy, alter output formatting, or adjust rate limits. The workflow platform belongs to a company that can restructure pricing tiers or retire a connector. The data source belongs to whoever runs the API, and API terms change, sometimes overnight. Sometimes with a price increase measured in orders of magnitude. As several developer ecosystems learned when major platforms restructured API access in recent years. An agency's entire asset base is a set of configurations that only have value while 4 or 5. External parties continue to behave the way they behaved when you built it. Traditional agencies sell labor and keep their skills. Software companies sell code and own it. This model sells the dependency between things it doesn't control. Which is why the honest way to describe an AI automation agency's balance sheet is that it holds no assets and a growing stack of obligations. Here's the part that turns that exposure from a risk into a compounding problem when automations break. They usually don't announce it. A website going down is loud. Everyone knows within minutes. An automation that quietly starts misclassifying leads or writing replies with a formatting error. Or skipping a database write because a field name changed produces no alarm at all. The dashboard still shows runs completing. The logs show green. And for 2 weeks, a lead scoring workflow marks qualified prospects as cold. Or a reporting automation feeds a slightly wrong number into a slightly important decision. The failure is discovered by a human noticing that something feels off, which means it's discovered late. After the damage has accumulated and after the client has already made choices based on bad output. The gap between failure and detection is where the money is lost. And it is longer in AI systems specifically because a language model that misunderstands an input doesn't crash. It confidently produces something plausible and wrong. Now watch how a single upstream change becomes a business-level event. A provider deprecates or updates a model, or a platform quietly tightens a policy. 20 of your automations depend on that model returning output in a specific shape. So several of them begin producing subtly malformed results. Nothing errors, so nobody is notified. 10 days later, a client realizes their pipeline data is wrong and, worse, that they've been ignoring real inquiries. Trust does not degrade proportionally to damage, it collapses. They demand a fix immediately, they want a refund for the period. And they mention it to the 2 peers who referred them. You spend the next week doing unpaid emergency engineering across every client, because if one broke this way, all of them might have. That week produces 0 new revenue while consuming your only scarce input, your attention. The retainer that was supposed to be passive income has become negative income. And now the cash flow hole needs filling, so you sell harder. More clients, more surface area, less maintenance capacity per client. And a higher probability that the next silent failure goes undetected longer than the last one. That's the loop. It isn't caused by incompetence. It's caused by selling fixed-price permanence on top of infrastructure that guarantees you nothing. If this sounds theoretical, the industry has already run the experiment once, with almost the same script. In April 2016, Facebook opened its Messenger platform to bots. Within months an entire service economy formed around it. No-code builders like Chatfuel and ManyChat made it possible for a non-engineer to assemble a conversational funnel in an afternoon. And thousands of small agencies appeared selling exactly the promise we started with, build the bot once. Charge a monthly fee, watch the recurring revenue accumulate. The value proposition was genuinely strong. And the reason was one specific platform behavior: bots could message subscribers again after the initial conversation. Which meant a business could build a list inside Messenger and broadcast to it. Open rates on those broadcasts were widely reported to dwarf email, and that gap was the whole business. Agencies priced against it. Courses were sold about it. For roughly 3 years it worked. Then the platform changed its mind. Facebook progressively tightened its messaging rules. And the changes it announced around 2019 and enforced in 2020 restricted the ability to message users outside a narrow window after their last interaction and removed the broadcast-style subscription messaging that most non-news businesses had been relying on. Read the mechanics of that decision against everything we've established. The agencies had not built a bad product. Their product worked exactly as designed. What disappeared was a permission, a single clause in someone else's policy document, and the entire economic justification for the retainer vanished with it. Clients didn't ask for better bots. They asked what they were still paying for. The agencies that survived were the ones that had never really been in the bot business. They had client relationships, understood a specific vertical's funnel, and could redeploy that knowledge into whatever channel came next. The ones that died were the ones whose expertise was the tool. That's the whole lesson. And it's the reason the current wave deserves scrutiny rather than mockery. The pitch is identical. The dependency is deeper. And there are now 4 or 5 platforms capable of playing the role Facebook played instead of one. There is one more piece of the economics that almost never gets discussed openly. And it explains a lot of what you see online. In this market, the most reliably profitable customer is often not a business seeking automation. It's a person seeking a business. The information layer, courses, communities, templates, coaching, done-with-you programs teaching people how to start an AI automation agency has structurally better economics than the agencies themselves. And for reasons that follow directly from everything above. A course has no maintenance obligation. It has no platform dependency that can void the deliverable. It has no client demanding a 7 a.m. fix. Its marginal cost really is near zero, which is the property the agency model only pretends to have. And its addressable market grows precisely when the underlying opportunity looks most exciting. Meaning demand peaks during hype rather than during results. I want to be careful here, this is analysis, not an accusation. And plenty of practitioners teach from genuine operating experience. But if you've ever wondered why so much of the visible content in this space is about the agency model rather than from inside a working one, the incentive gradient answers it. The apparent product is automation. A meaningful share of the actual revenue in the ecosystem is education about automation. So what did the operators who actually built durable businesses do differently? They stopped selling automations. Adaptations show up repeatedly, and each one is a direct response to a weakness we've already identified. First, verticalization. An agency that serves only dental clinics, or only freight brokers, or only law firms, accumulates process knowledge that no platform release can commoditize. Because the hard part isn't the workflow, it's knowing which 14 exceptions exist in that industry's intake process. That knowledge is the only asset in this business that appreciates. Second, outcome pricing. Instead of charging for a system, charge against a measurable result, recovered carts, qualified appointments, hours removed from a documented role. It's harder to sell and requires real attribution discipline. But it moves the conversation away from a deliverable whose market price is falling toward a value whose price is set by the client's own economics. Third, reframing the sale as internal tooling rather than growth magic. Which changes who signs and why. An operations director replacing a documented manual cost is a durable buyer. Whereas a founder buying a lead generation miracle is a churn event with a start date. Fourth, and most telling, many of the strongest operators stopped being agencies at all. They noticed the same workflow being sold to the 40th client in the same industry, productized it, and became a small software company, or went further and used their automation capability inside businesses they own or acquired, capturing the full margin instead of billing for the tooling. Which is worth sitting with. The most successful exit from the AI automation agency model is frequently to stop running an agency. What that means practically is that the model works, just not in the shape it's usually sold. Best case, and this genuinely happens, you spend a year absorbing painful operational knowledge in one narrow industry. Turn it into a repeatable product. And end up with a small software or operating business with real margins and no dependence on your personal attention. Realistic success looks less cinematic, a small, deliberately capped portfolio of clients in 1 or 2 verticals. Contracts with usage pass-through and defined maintenance scope. Monitoring good enough to catch silent failures before the client does. And a comfortable income that behaves like a well-run consultancy, because that is what it is. Realistic disappointment is a business that reaches maybe $15,000 a month. Plateaus there because every new client consumes the maintenance capacity of the last one. And slowly converts its owner from a builder into a support desk for systems they no longer find Interesting. And failure is quieter than people expect, not a dramatic collapse. But 3 clients churning in the same quarter after one silent breakage, no cash buffer. No vertical knowledge worth redeploying. And a skill set that turns out to have been a temporary arbitrage on a capability the platforms have since bundled for free. Which returns us to the weekend build and the $800 retainer. That arithmetic was never wrong. It was just measuring the wrong thing. The build cost is low. But the build was never the product. You were selling the promise that when a model changes, or an API is deprecated, or a policy document is rewritten by a company that has never heard of your client, someone will already be handling it. That promise is valuable, it's defensible, and it's genuinely worth paying for. It's also the opposite of passive. So the honest way to understand this industry is not as software with an unusually low startup cost. And not as a scam. It's as a business that converts other people's technological volatility into a monthly fee, and the only operators who last are the ones who price the volatility instead of pretending it wasn't there.